China sold a record amount of stocks, $5.1 billion in the month of August.
China has been quickly selling U.S. Treasury bonds.
China sold a record amount of U.S. Treasury and agency bonds.
China has sold more than a third of its U.S. Treasuries in the last decade, from around $1.2 trillion to around $780 billion. At the same time, China is buying record amounts of gold. In fact, its central bank is buying gold aggressively for more than a year now. Does that mean that China is planning to slowly dump the US bonds, which will crash the US economy? Okay, before we accept that fear, we need to ask three simple questions. Can China actually dump the US treasuries that easily? If they do, will it hurt the US economy? And is China's gold buying really a step towards abandoning the dollar? To find the truth, we'll have to compare the panic with the numbers. How much impact will a $780 billion dumping of the US treasuries will have on the US economy? And above all, I'll show the math why it is difficult for China to dump the US treasuries. So let's start. Alright, let's imagine that China actually starts dumping US treasuries in large chunks. What will happen then? See, when this happens, it increases the supply of US bonds in the global market. And you know, when supply of anything goes up, its price goes down. Simple economics. Hence, US bonds price falls. So if China sells treasuries, then the US treasuries prices will fall. And you will say that's alright. Why China has to worry about falling US treasury bond prices, right? Like China sold the US bonds, and whatever happens to the price of the US bonds, why will China be concerned at all? So, you know, there is a problem. The problem is that China cannot sell all of the US bonds, all of the $780 billion of US bonds what China has at today's price at once. The actual scenario will be a little different. So as China keeps selling, the price of the bonds keep falling. Meaning the more it sells, the less it earns per bond. A simple illustration can be seen in this table. Do not get scared by the numbers, I'm just taking them for making you understand the scenario. You see what's happening here. If the price of a US Treasury bond starts at $100 for example, and China begins dumping large amounts into the market, the price does not stay at 100. It may drop to 90. That means for every $100 of bond, China will only get $95 back. The more it sells, the more the price drops and the more money China loses on selling every remaining bond. In simple words, China would be destroying its own assets trying to dump the US treasuries. But wait, you might even ask that why wouldn't China sell everything before the prices even drop? Like why would it wait for the prices to fall? See, there is a reason. The reason is that the financial markets are not stupid. The moment traders sense aggressive selling, there are high chances that hedge funds, banks, and other investors will simultaneously start selling before even China does. This is called front selling in economics. So prices collapse even faster before China can even exit. And remember, US treasuries don't have a fixed price, their values change every second based on the demand and supply in the market. Another thing to consider here is that if China starts selling aggressively, it will need buyers, right? These buyers, which are traders and other financial institutions, can see what's happening. They realize that China needs to sell. So buyers will not offer the full price anymore. The more China sells, the lower the market offer becomes. That further intensifies the fact that China will receive less and less as it continues to sell the US bonds. It's like a clearance sale, but on your own national wealth. Now don't get me wrong, the US will also feel the heat, but China burns itself more, which you will learn why as you progress through the video. Now let's talk about the second reason why dumping the US treasuries is a bad option for China. Now to understand this reason, we need to get some perspective on how China's economy actually works. Okay, China's economy is pretty interesting. China is an export-driven economy. Its growth depends on selling manufactured goods to other countries, and the United States is one of its biggest buyers. To give you a perspective, in 2024, the United States imported nearly $440 billion worth of Chinese goods, while exporting only about $143 billion to China. That means China earns a massive trade surplus every year with the United States. Now, most of the money from exports to the USA comes in US dollar to the Chinese exporters. But as you know, China's currency is yuan. Hence, the Chinese exporters need to convert the US dollars into Chinese yuan to cover their operating costs from paying salaries, rents, and suppliers. Now, something special happens in the case of China here. But to start, let's consider the normal scenario if it would have been any other country and not China. So in the normal scenario, if the Chinese exporters had converted the billions of US dollars which they received by exporting goods to the USA, then what would have happened? The supply of the US dollars would have increased in the market, whereas the demand for the Chinese yuan would also have increased in the market. Because, of course, the Chinese exporters would have given US dollars in exchange of receiving Chinese yuan. So the supply of US dollar increases. Now, the supply increase means the value or the price of the US dollar depreciates. Whereas when the demand for the yuan, the Chinese yuan increases, then its price or its value appreciates as against the US dollar. Hence, the value of the US dollar decreases because its supply increases in the market. And for the Chinese yuan, the price or the value appreciates because its demand increases in the market. That means the Chinese yuan appreciates in value over time as compared to the US dollar. You know, this is a self-correcting phenomenon which happens when two countries trade internationally. Now, a stronger Chinese yuan sounds good, but wait, this is not good for China's economy. Why? See, there is a reason. Because a stronger yuan makes the Chinese goods more expensive in the global markets. For example, a $10 Chinese doll might now cost $15 when the Chinese yuan appreciates in value compared to the US dollar. China needs to have a cheaper yuan to make its goods competitive and cheaper in the world market. Otherwise, foreign buyers will start shifting orders to other export houses like Vietnam, India or Mexico. In that case, Chinese factories will lose business, jobs disappear, and growth slows down. But you know, this is not the case. There is a special arrangement which China uses or the Chinese government uses to stop its yuan from appreciating. This arrangement is an intervention by the Chinese government and the central bank in China. Here's how it works. Chinese exporters earn US dollars when they sell goods abroad, right? So the difference is, instead of letting the Chinese exporters convert those dollars into yuan in the open market, which would increase the demand of the yuan and hence will appreciate its price or value, the People's Bank of China intervenes and it buys those US dollars directly from the Chinese exporters. The People's Bank of China buys those dollars directly from these exporters and pays them in yuan. Now, the People's Bank of China can print, sell bonds and apply other methods to meet this demand for yuan. Hence, the demand for Chinese yuan does not increase in the open market, and hence its price also does not appreciate. Now, the US dollar, which the People's Bank of China collects from the Chinese exporters, doesn't stay idle. They go to the foreign exchange reserves of China, which had reached $3.2 trillion in 2025. Now, these US dollars, which the People's Bank of China gets from the Chinese exporters, need to be parked somewhere, need to be invested somewhere. Where would the Chinese central bank think of parking these excess US dollars? Into some safe assets, right? So most of these US dollars get invested into US treasuries, which are by far the most safest assets, which can give China a risk-free interest. So this is a cycle and a relationship between China and the USA, where China sells its exports to the USA to get US dollars and then use those US dollars to buy or fund the US debts. The US uses this debt to buy Chinese exports, among other things. Now let us ask again, what happens if China suddenly starts selling those US bonds in big chunks or starts dumping the US bonds? And remember, we are talking about large chunks of US treasuries being sold off by China. In that case, China would receive large amounts of US dollars in return of selling those US treasuries. Now again, to use those US dollars, domestically, China would need to convert those US dollars into the Chinese yuan. This again increases the demand for Chinese yuan and increases the supply of US dollars in the Chinese market. The yuan starts to appreciate and the dollar weakens against it. But wait, you may ask that, like we saw earlier, can't the People's Bank of China intervene again and buy those excess US dollars? The answer is yes, but theoretically. Why? Because the scale is massive this time. So under the normal condition, the People's Bank of China maybe absorbs $50 to $100 billion a month through exports and trade surplus. But if China suddenly sells $700 to $800 billion worth of US treasuries, then the People's Bank of China would have to absorb 8 to 10 months worth of dollars in one go. So that's like saying, for example, you normally drink, let's say, 1 glass of water per hour, but now you're drinking 10 liters of water in 5 minutes. And it gets worse because, as we saw, China would already be losing money by selling treasuries at a discount. So in a nutshell, the value of the Chinese yuan appreciates as the People's Bank of China would not be able to absorb such a huge impact. Again, if this happens, like the value of the yuan appreciates, then the Chinese goods become more expensive and less competitive in the world's market. Export orders fail, factory profits drop, and unemployment rises. In short, dumping US treasuries means China risks damaging the very engine which powers its economy. Now let's also check the impact on the USA if China dumps its US Treasuries bonds. To understand the impact on the USA, we need to get a perspective on the size of the US Treasuries market. According to the reports, as of Q1 of 2025, the total size of the US Treasuries market is around $28 trillion. And every single day, around $900 billion to $1 trillion of these US bonds are bought and sold in the market. And this is not the new bonds, this is just the existing bonds changing hands between investors. Now, as we know, China holds only $780 billion of US Treasury bonds, which is only 2.5 to 3% of the entire US Treasuries market. And when you compare it with the daily trading value also, China holds less than 1 day's worth of trading. So China is not holding a nuclear button, it holds a small slice of a much larger system. It is one of the players in the US Treasuries market. In fact, around 70% of the US Treasuries is held by the Americans themselves. This includes the Federal Reserve, government trusts, insurance funds, pension funds, and mutual funds in the USA. So when people say China owns America, the truth is that America owes money mostly to itself. Even if China starts selling, yes, the US Treasury prices might fall for a while and the yields might rise, but the market is deep enough to absorb it. Japan, US pension funds, investment banks, hedge funds, even the Federal Reserve would begin buying. This can go wrong only if others are also not trusting the US economy and start selling the US bonds. I think this is the bigger concern for America, which is actually happening these days. Lack of trust from investors, not only China, but Japan, UK, and all the 70% of the internal investors in the US. But it's a separate discussion altogether. But you know, the USA has got tools to counter this. The USA has a floating economy and it can print dollars. But if the USA starts printing dollar to stabilize the market, the inflation rises. It would be bad for the USA, but good for its debt. Again, I'm not saying that it is at all good for the USA, but this is a separate topic of discussion. We are discussing in this video about China, how China selling of US bonds can impact the USA. With inflation, the value of the debt will reduce and it will be bad for the creditors like China. But again, this is a political risk and not China dumps US bonds risk. I'd ask, and I also wanted to know, why then is China buying record amounts of gold? Is China actually looking out for replacing the US treasuries with gold? Or wait, is that something else happening that we should know? Every month for 11 months straight in 2025, China has bought gold. Reports suggest that gold now makes up around 7% of China's foreign exchange reserves. And a decade ago, gold was only about 2% of the foreign exchange reserves in China. But when you compare it with the gold reserves of other de-dollarizing countries like Russia, it is still the beginning for China. Gold makes up around 34 to 35% of Russia's foreign exchange reserve. So the point I'm trying to make in comment is that China is not completely trying to escape the dollar system. No, it still does hundreds of billions of dollars of trade with America every year, even after Trump's tariffs. Although that has reduced, but it has continued to trade with USA. What China is doing is reducing risk and not cutting ties. Gold is an insurance and a hedge for China. And China knows something important, that global politics change. Like a new US president can change the tone overnight. Even US courts are now questioning whether Trump's tariffs were even legal. So China is not planning a dramatic goodbye to the dollar. It is planning something smarter. That is, we'll use the dollar when it helps us, but we are not going to blindly trust on it anymore. It's not a destruction, but a preparation for China. Thank you. If you like this video, please like and subscribe and comment. Thank you.